Hello, and welcome to a new episode of the Burn Your Boats podcast. I'm your host, David Shaw, here on my own today. And I normally come to the table here with something that I'd kind of like to get off my chest or talk about. And as I'm in the private lending business, I thought I'd take a minute to demystify some of the conversations I'm having. When I talk to people about being a lender, a lot of people will kind of react to that in the sense that sounds risky, right? I'm going to let that sit there for a minute. It sounds risky. Lending, it sounds risky. But actually what it is, it's just something they, by and large, don't understand. And so instead of having these conversations one-on-one every single time, I thought I'd have that conversation today on my own. And so basically how I have learned about lending is by being on the other side of the loan. I've taken out, scores and scores and scores of mortgages. I've taken out hundreds of private loans over the years. And I thought I'd talk about it really from both sides of the table, as in why I have used debt. And now that I create debt, why I now earn money from the debt side. Okay, so here we go. It's the confessions of a private lender, if you will. So let's start off with the big question. Lending, it sounds risky. Tell me more. The bottom line is this. When you go and you take out a mortgage on a house, almost always, without going down a rabbit hole, you're taking out a first position mortgage, which means nothing else trumps the repayment of that. When that house sells, the title company will look up who's owed what on the house before they give the money to the owner of the house. The title company will look up the deed and look up the chain of title and say, okay, we have a recorded lien in the local county court that $200,000 is owed to Bank of America on this house. So if the house is being sold for $300,000, Bank of America need to get 200 of that, and then the title company will distribute, 100,000 to the seller. That's basically how it works. So you've got a mortgage. That mortgage is recorded, and this has been going on since the earliest biblical times of writing and writing things down. People weren't writing stories. They weren't writing the Torah first. They were writing and recording loans for goods and services in stone. So we're going literally back to the Stone Age. If somebody wanted to borrow either money or land or, cows, they would record it by chipping stuff into a stone. And then when it was paid back, they would knock it out in stone. So borrowing and lending is the cornerstone of human interaction and financial interaction with each other. So it's a good time as any to understand that lending has been going on since the dawn of time. Now, if it was so risky, why would people have not stopped lending in the 600s or in the Middle Ages or 10 years ago? Why do people still loan? People loan because it's a secure way of earning income. So let's demystify that for you. As a borrower, my first exposure to lending was really as a borrower. And so my first property, I ever bought, I bought it with a loan. And I went through with all the mortgage application and I bought the property. I owned the property for 5 years. Then I sold the property and, the loan got paid off and I got the balance of whatever was left. Very simple way to understand it. Most people understand that. Then I went into fix and flipping. And I remember not fully understanding how debt works, walking into my bank and saying, look, I'm trying to buy this house. And the bank was like, what are you going to do with it? I'm going to flip it. And they laughed at me. So like, no. We do 30-year loans or 5-year loans. but we don't do 5-month loans. So I'm scratching my head. I go, how am I going to be able to buy this next deal? Because this is kind of before Bigger Pockets and all these other things. I'm like, how am I going to get this deal done? And so I start calling around, and I call a friend, and he introduces me to the whole concept. He's like, what are you buying? Where are you buying it? Show me over your deal. So I sent him over the deal because, yeah, I'll lend you the money on it. I'll give you money for that deal. And I'm going to record a loan and a mortgage against your property that you're rehabbing. Like, that's amazing. Thanks a million. So sure enough, on closing day, they wire over the money and I get my deal done. Now I have to pay heavily for that, in that my very, very, very first few loans, I gave the lender, a high rate of interest and 50% of my profits. Suffice it to say, I didn't really like doing that, right? And so I learned a little bit more about that there are actually companies out here that provide short-term capital. And in that scenario, I go out, I put a house under contract, I bring it to them, and this is what they do. They look at the deal, they say, yeah, you got a good deal. I like what you're saying here about your renovation fees. We like the value. We see this value as $400,000. We see that you're buying it for $200,000. We like this deal. We'll give you a 12-month loan. And so that was my first real experience, if you will, of short-term private lending, right? Because there's lots of different types of lending out there. There's car loans and student loans and second home loans and boat loans, credit card loans. There's all sorts of lending out there. Usually they're secured by different types of collateral. And so in the case of private lending, it's always secured against an asset of some sort, right? I would say secured against, I mean, in a first position lien. Now, first position lien is just a very simple concept. If the house sells, who's the first to get paid? The first position. If the house sells, who's the second person to get paid? The second position. And so on and so forth down the lien stack. And you could have, as I say, you could have a bank, you could have a relative, you could then have a HELOC, you might then have your HOA or a roofer or somebody along these lines will have extended credit to you in some way, and they will have recorded a lien against your home so that when you come to sell your home, all of these people are going to get paid in that priority. And so let's think about our original question. When I talk to people, I say, hey, listen, I'm in the lending business. They say, it sounds risky. Well, let's find out who's at risk. So somebody comes to me, let's do a real world example. Somebody comes to me and they say, David, I've got this property under contract for $200,000. I'm going to spend $50,000 on it. And, I've got my closing costs, I've got my holding costs, I've got, permit fees, I've got then my sales costs and all of that. That's called underwriting. So they have all of their underwritten costs and they present all of that to me. And I'll say, okay, well, you've done this a few times before. Yeah, yes, I have. And that's number one. So your experience. Number two, I'll look at your numbers and say, yep, I like all of those numbers. They're accurate because I've done this a couple of hundred times myself. So I'm like, yeah, that's about right. Then I look and I get the data and I'll look at the market that they're in and I'll start pulling what they would call comparables. And if they tell me it's worth $400,000, I need to go verify, like, yeah, that's worth $400,000 all day long. It's a good deal. And you're not pumping up your numbers. Your numbers look good to me. And then I'll get a third party, somebody I don't know. I'll say, go and tell me what the as-is value, tell me what that house is worth right now in its current condition. And then tell me what that house would be worth if it's, beautifully renovated to this standard. And so the third party will come back and give me two numbers. And if they chime with my numbers, I'll know then that if I extend a $200,000 loan on a $400,000 asset, I'll know this. The borrower has come to me. They want a $200,000 loan. The borrower is then going to spend $65,000 of their own money, putting a new roof on and kitchens and floors and doors and baseboards, right? And then the borrower is going to sell it for $400,000 and make $70,000. The big questions that people ask me are this: David, it sounds really risky. What if the borrower doesn't pay? Well, think about it. The borrower is going to immediately lose their deal. I need to get paid. I've got a first position lien at $200,000, and I can force this house to be foreclosed, to be sold in a foreclosure auction. So the house is worth $4. I'm going to just sell it for $2. So I'm going to sell it all day long. There's going to be like 1,000 people trying to bid on this to get it for $2. Okay. Also, the borrower has probably spent, renovation costs, closing costs, and spent a lot of money getting the deal under contract at that price in the first place. And they almost always will have a fairly big deposit on the home. So the borrower is going to lose their money. Then they're going to lose their deal. Then they're going to lose their profit, that the $70,000 or $80,000 they were going to make. Then they're going to lose their credit score. Then they're going to lose their entire reputation in business, and they will never be in business again in that particular thing, be it renovating houses. And so people don't default on houses where they have skin in the game and where they have a profit to be made and where their reputation is at stake. Now, let's go to a worst case scenario. Let's say they die and they just disappear. Now, the borrower is gone. In that case, we'll foreclose on the home, we'll sell the home in a foreclosure auction, and we'll sell the house for, the county auction will sell it for, $310,000. It's being sold at a discount, and I'll get my $200,000 in the foreclosure auction as the plaintiff. Okay, so that's how I recoup my money in a worst case scenario. That's in a death. But in most cases, here's what really goes on in the case of a default. A borrower will default for a number of reasons, but it's very rare. And I'm talking like 0.0005% of loans that are out there will default at all. So it's exceptionally rare that you'll have a full default all the way down to a foreclosure. What's more likely is sometimes you get a borrower who misses a payment. In that scenario, the borrower goes on to default rate right away. So instead of missing their payment, they're now the rate at which what they owe is like $150 or $200 or $500 a day. So now they're like, okay, now they're really losing the clock has started ticking, the time bomb, if you will. The pin has been unplugged from the grenade, if you will. And so at that point in time, they need to decide how they're going to handle the situation. More often than not, what the borrower will do is they'll pass the deal on to somebody else, they'll sell the deal to somebody else, they'll wholesale the deal to somebody else, or they'll refi out the loan in the first place. So it's really important to understand that the very last thing in the world the borrower will want is to lose their profit and then lose their reputation. So there's a lot of exit strategies before a foreclosure happens. Like after a default, as in they missed their monthly payment, and before a foreclosure, they will wholesale it, they'll refinance it, they'll bring in a JV partner, they'll do whatever they can, and they 99 times out of 100 will get back on track within a few days, and the loan will just continue, and the plan will be brought to fruition. If they get to the end and they can't sell the house or whatever, they'll mostly just refinance the house, put a tenant in it, and you get paid your money back. So I want people out there to understand how rare a default is with a private loan. You might say, oh, well, look at 2008. What you're talking about there is FHA borrowers that are, on government secured loans with 3% down that were not professionals. The only thing they were walking away from was 7 years in, bad credit purgatory, right? We do not lend with 3% down to consumers with no skin in the game and no money. We lend to people who are professionals. They're business people. They have business reputations. Their credit score is their lifeline to their career. So they would be creating career suicide. And most of these people are already pretty wealthy. Now they have a personal guarantee on any loan that they didn't pay. So not only are they going to lose the profit and the equity and the reputation, they're still not off the hook because they have a personal guarantee. And so now the borrower can go after their other assets. And so private lenders very, very rarely experience a full default on behalf of a borrower. That's number one. I'm not saying it never happens, but I'm saying it's very rare. And when it does happen, there are multiple exit strategies for the borrower, and then there are multiple exit strategies for the lender too, in order to fully recoup their loan. So they might be out some interest payments while they're foreclosing on a home, but when they foreclose, they'll get all of their back interest payments when the house gets sold. And so then the next thing people say is, what if the market changes? What if there's a fluctuation in the market? And that might be real. But let's talk about in a case where there's a 70% loan to value. That means the loan is worth 70% of the asset. So a number of things would have to happen. The market would have to fall more than 30%. And the borrower would want to be willing to commit financial suicide. That just doesn't happen. Go back to 2008 and 9 and 10 and 11. The market didn't just drop 30% in any one year. It dropped 12%, and then 13%, and then 9%, then 8%, and then 7%, and so on and so forth. Cumulatively, the market dropped, depending on where you were, between 15% and 50%. But it happened over a 5 or 6 year period. Didn't happen overnight. Private lending is usually year loans. So in any one year, it's highly unlikely that the market will drop 30% in 1 year. And even if it did, most borrowers will still be in the money because they've got their own down payment and they've got their own strategy. And then they have usually lots of other assets to allow them to clear out any loans that they have. People in business don't burn their lenders. It's very, very rare. So first risk that people say, what if the borrower doesn't pay? That doesn't happen all that often. What if the market drops? That's a big what if. It doesn't happen. Not 30% in a year, in 12 months. I'm going to tell you where the real risk is, and nobody asks me this question. The real risk is in the lender not understanding the paperwork, the loan documents, because a loan is paper. There's a reason it's called a loan note. And there's a reason people say, well, I exchanged paper, right? I bought paper. You may have heard these terms before. What they're doing is they're exchanging debt. They're buying each other's loans, which is a whole different conversation. But the loans and lending is underwritten by paperwork, right? We've been writing this stuff down since the Stone Ages. And so the paperwork is what confers. So when you buy a house, you're getting a house. When you buy a loan, you're getting a lien. You're getting the rights to foreclose on that home. So you better have the paperwork behind that correct. And so that is why in my case, I know what I know. I know the borrowers. I know how to read a borrower well. I know the house. I know how to value it. I know renovations like the back of my hand. But guess what I don't know? I don't know legal paperwork like the back of my hand. And I'm no expert, and I'm no real estate lawyer. So I connected and I brought in a lawyer when I went into doing my lending myself. Very first call I made, I need a lawyer. The lawyer needs to be adept at foreclosure, defense, and offense. And there's really the big things to understand when you're lending to somebody is who you're lending to. More often than not in real estate, you're lending to an LLC. So you might be lending to Derek, but Derek's entity is an LLC, and that LLC is doing the buying of the asset. And so you need to understand the operating agreement and the articles of incorporation of that LLC. So you have to understand, is Derek the sole owner of this LLC? Or does Derek have a partner who he hasn't even mentioned to me? Because in the operating agreement, if I create a loan and only Derek signs it, but I find out that Derek's got a partner and Derek's partner didn't know that he was, buying a loan with this LLC and a partner didn't sign it, well, guess what? You, the lender, might be just shit out of luck because now your loan is unenforceable on that asset. So this is where the risk is in lending. The risk is not in understanding your borrower, not understanding their LLC, not understanding if they have partnerships, and not filing your paperwork correctly. I implore you, if you're ever thinking about making money and creating loans, I implore you, bring a real estate attorney onto every single deal. Don't just ask the real estate attorney to draw up some lending docs and then that be it. Unless you know every trick in the trade, bring in your attorney to review your borrower, your borrower's LLC, and your borrower's operating agreement, articles of incorporation, and that your lender is revising all of the loan documentation on each and every loan. Do not let your title company or think that your title company is that role. The title company is not that role. So I've just told you where the risk really is. The risk is not in the borrower, really. The risk is not in the market, really. The risk is in the paperwork. And so with all of this being said, right, and this is the mystery, right? People say, oh, private lending, it sounds risky. I've just told you where the risk is, right? Where it is and where it isn't. It's very, very fixable. Get a great lawyer. Have that lawyer review all of the documentation and review your borrower's LLC. Get a great borrower. Just understand the asset which you're borrowing. Put a fairly limited loan to value. Don't loan 100% on the asset. From there, lending is safer. I got to say this very clearly. Lending to me is safer than going out and buying the asset myself. Because when I go out and I buy an asset, right now, I go buy a $500,000 home. I put $100,000 on that home. If the market were to fall over a 2 or 3 year period of 30% a year, never happens, but there you go. Whose 30% is getting burned off? It's mine, not the lender. The lender just doesn't care. When I have a broken garage, I don't call my lender to fix my garage. I have to fix my garage. Just last weekend, I had an electrical surge in one of my houses, blew out everything in the house. Probably cost me 10 grand in new appliances, blew out my irrigation, blew out my AC, blew out everything in the house. My lender hasn't received a phone call. My lender got paid this month. Lending is a very, very nice position to be in. And I'm going to end this with a quick example of why I lend versus why I own. A little bit over a year and a half ago, I bought a house for $230,000 and I spent $120,000 renovating it. So I'm all into this house for $350,000. It's gorgeous. It's really beautiful. I did a great job and I bought it well. That house today is worth about $500,000. Okay? $500,000. Doesn't have a loan on it. And I am left with a decision. If I rent this house out, I can rent it for $3,000, but after property taxes, insurance, management fees, all that kind of stuff, I will probably walk away somewhere in the region of about $2,000 a month. So here we have a $500,000 asset and no mortgage, unencumbered, will give me $2,000 a month. If I were to sell that house, and let's just say I sold it and my net proceeds were $500,000, and I was to take that $500,000 and lend it out at 12%, which is a normal number. Well, now as the lender, I don't have to deal with the tenant because I don't have a tenant anymore. I just have a loan. I don't have to deal with maintenance. I don't have to check my monthly statement and get pissed off every month when I see the property manager has done this, that, or the other. I don't have to worry about a lease ending. As the lender, I get 1% a month of the 500. So now I'm getting 5,000 a month. Now think about that for a minute. As the owner, with no mortgage, I get 2,000 a month. As the lender, if I was to take the same capital and lend it out, I get $5,000 a month. No tenants, no toilets, no leases, no atrophy of the home, no depreciation, nothing. I just 5,000 versus 2,000. That is why I loan. Right there. Because I'm equally protected as I am owning a house free and clear. Quite frankly, it's more scalable, right? Now you need to have the money. Now let's look at the advantages and disadvantages. Lending is way higher cash flow than owning a property without a mortgage. With a mortgage, there's no cash flow. So lending does not give you any tax breaks. It's ordinary income. So government does not incentivize you to be a lender, right? You don't get mortgage interest relief. You don't get depreciation. You don't get bonus depreciation. You don't get any, nice tax treatment. It's just ordinary income. Now, as a owner of the real estate, I might have depreciation, mortgage interest relief. I might have bonus depreciation if I'm a professional. And so there are tax advantages to owning a home. I also will get appreciation if the market goes up. I get depreciation if the market goes down. So I'm not saying there's one or the other. I'm saying as well as I do own real estate, and I do keep, in this case, that house I just outlined to you, and I keep it largely for offsetting taxes, and the taxes I'm offsetting are from the private loans that are generating income. And so for you out there, and I hope that this has been somewhat useful, private lending, real estate lending, hard money lending, people want to call it different things. It's not any more risky or, than any other form of ownership of any real estate. If you've got a loan on real estate, it's actually less risky than the asset that you own, no loan on it. So think about your house right now, or think about any other asset you own, right? How much does the lender owe on it? How much is the lender owed? You might have, the lender is owed $200,000, and you might own the house and it's worth $600,000. You're never not paying that lender. Never. It's inconceivable. And so for those of you who default to it sounds risky, I'd ask you to educate yourself a little bit. Learn about private lending, if this sounds interesting at all. Because private lending, as far as I can see, as far as I know, it's one of the few assets, and a loan is an asset. Just like owning the home is an asset, a loan is an asset. Remember that. It's an asset, right? It can be sold. You can sell a loan. You can buy a loan. You can trade a loan. You can get a refinance on a loan. You can do everything with a loan that you can do with a house. It's just people feel the house is more tangible because they can see it, they live in it, and they can kick it. Whereas a loan is this intangible thing. But legally speaking, they're both exactly the same. And so the reason I have evolved and over the years, and now I'm so passionate about lending, is because when I was a young man, I needed loans. And I understand what I needed. And I never defaulted on a loan for a nanosecond. And people in the business do not. And so I understand who we're helping. We're genuinely helping people out there do business. And on the recipient side, it is such nice income. You can derive it and originate it from anywhere. You could be in Antarctica. As long as you have an internet connection, you can create a loan, you can pay off a loan. It's a beautiful form of income. And so I ask you, is lending more risky or less risky after listening to this? With that, I'm out of here. I hope you've enjoyed it. Thank you so much. And please reach out to me if you have any questions or you want to add more to this argument, and I'll jump straight back in I will have a conversation about it. But you should learn to lend yourself because it's a flex. I enjoy it, and I've got to continue lending for the rest of my life. So with that, I'm out of here. Have a great day. Thank you so much for tuning into today's episode. Look, we truly appreciate your support and hope you found the conversation insightful and engaging and useful. If you enjoy the show, because there's a lot of shows out there, would you please take a moment to rate and review us on your favorite podcast platform? Your feedback helps us grow and reach more listeners. We hope you enjoyed today's show. Thank you so much.
You've been listening to the Burn Your Boats Wealth podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at contact@burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats Wealth podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you and have a great day.